This example begins with the boundary between the 30s and 40s remaining highly influential despite large fluctuations in price over the years. Examples of strong bullish and bearish continuations emerge around this key 39 to 41 area. Following the clear lower wick rejection from this area, the market remains neutral to bullish. Some strong bullish surges, however, the strength is not as consistent in terms of the volume when compared to the still constant selling pressure that remains. Though in the meantime, periodic surges in bullish volume and strong rows of green candles are adequate to continue the overall uptrend. Eventually, this leads to the sustainability of a long-term uptrend being called into question, as relatively moderate selling pressure is able to return the market to a more bearish to neutral stance. In order to clear back into the mid-80s and beyond, the market needs to form another bullish surge in order to see a longer-term bullish continuation. If not, then this short-term lower boundary remains under pressure. Minor bullish sentiment remains to keep the lower boundary for a short time longer. However, in the broader context, the bearish advantage is renewed. Immediate follow-through the next day for a likely 3 black crows continuation in the shorter-term context. Indeed, a 3 black crows takes down stock price firmly. There is a gradual slowdown due to short-term downward overextension and decreasing volume in general. Bullish volume and lower wick rejection are present. However, they aren't sufficient to counter the relatively stronger bearish price action and volume in the broader context. A bearish advantage is maintained to drop towards 41, where before there is even direct contact with this long-term range, there is another major upswing, similar to the one seen at the beginning of the previous year. Familiar sights here following a sharp bearish star peak, there is gradual slowdown into a more neutral to bearish range. And despite some bearish spikes, the upper 50s remains a solid lower boundary in the short term, but eventually this is breached with a strong close under 58. Once again, another resting phase completes for another likely downward continuation. In the short term, a 3 black crows also emerges, and this has less strict criteria when compared to theoretical diagrams. Gaps between the real bodies could be more abundant. However, this is not much of a problem since real body overlap is only minor. Other than that, everything is very close to theoretical diagrams. The wicks are small and the real bodies are large, essentially spinning tops in a bearish context with increasing volume as well. In the end, the result is the same, one large drop, whether there are complete gaps or minor overlap between the real bodies. The overall price action and broader context is more important. Whether there are minor gaps, large gaps, or minor real body overlap, it is 3 black crows price action, leading to a sizable decrease in stock price. There is a lower close and bearish volume still remains exceedingly high. However, this is an inverted hammer, indicating the trend can begin to slow, and this may even lead to a bullish reversal. There is no immediate bullish reversal, however, the downtrend has slowed significantly. Though the next candle closed lower, it also formed another inverted hammer that was immediately confirmed for a strong close above its high. In the process, there is a morning star that has formed. It's interesting this happens at the end of December, when there is often lower trading activity due to holidays such as Christmas and the New Year. As usual, one of the first major resistance ranges is at the lower boundary of the prior downward continuation's resting phase. Bullish sentiment remained to continue higher, however, there was still significant resistance at the upper boundary of the resting phase, which eventually led to a sharp downswing. As would be expected, these prior price levels remained influential supports in slowing down the decline, especially the longer-term 39 to 41 range, which managed to halt the downtrend for quite some time. But when moving into the new decade, this key range was also breached. It was also accelerated due to the global stock market decline in early 2020, making for an extremely bearish continuation following the break of this key area.